Hi everyone, this is a short screencast for Independent Colleges Dublin for F6 Taxation, covering question 3 of the May 15 mock exam. This particular question covers the CGT area, and in this question we have a number of disposals, and we're simply required to calculate the CGT payable. So let me take you through that now. First part of the question relates to a set of shares in Planks PLC. And what we should try to remember in relation to sort of the matching rules for shares is that for an individual, any time that a purchase is made, then that purchase will have its own pool. So in effect, as I've said here, what we need to do in this with this first asset is build up really two pools for two separate purchases. And I think that's the problem for students, particularly when you build in bonus and rights issue. So in this first area with the shares, I think formatting is absolutely key, and you'll see that when we look at the answer, we're using a specific format with a set of columns, and it's just very important that you realize that where an individual has shares, that each purchase is going to have its own pool, as it were, and getting that format right for each pool and working through the bonus and the rights issue for each purchase is where you can pick up quite a lot of marks. So broadly speaking, what we have here is a set of purchases, and then we have a bonus and a rights issue. And we should remember from our studies that the bonus and rights issue is really based on the number of shares in hand prior to the bonus or the rights issue. Okay, so more of that later. In terms of the second asset, only two assets within this question, so it's reasonably short. We've got the old Ppr exemption, and we should know that basically Ppr is really an issue of sort of number crunching and trying to get our months right, really from point A, which is the point of purchase of a property, to point B, which is the sale of the property. And generally what the examiner does is break that period up into a set of different parts. And what we're looking to do is to really apply our knowledge of the Ppr rules, i.e. the deemed periods and indeed the actual occupation periods, and get the top half of that fraction, and then really strip out from the standard sort of three-liner proceeds less cost equals gain, just strip out the amount that's eligible for Ppr relief. Okay, so in this particular case, we have a house that's purchased in 1998 for 110,000 euros. Got a variety of information here in relation to fees that were incurred at the time of the purchase, and always, if in doubt, as I say in classes, if you see fees or costs, 9 times out of 10, or certainly at least 8 times out of 10, just simply deduct them from the cost, or indeed add them into the cost. They're always invariably going to be relevant. So where we have a cost of legal fees or stamp duty, etc., we're just really going to add them into the cost and obviously index up where appropriate. Now, one thing that's a little bit unusual here, and what the examiner does, is to include an element of the property that is used for trade purposes. So really what we've got to think about there is, well, if we have a property that is being used 20% for non-resident purposes, and in other words, it will not be Ppr relevant, what we're going to do is strip out that element of the game and make it chargeable. So really what we're saying is, in effect, 20% of the gain that is made is definitely going to be chargeable, and only 80% relates to the Ppr element. Okay, so we'll see how that works within the answer. In terms of what this chap Paul has done, essentially he's moved into the property as you would expect up here, notwithstanding the fact that part of it is used for trade purposes, and decided in July 2008 to actually move out into a new home. So it looks as if we have a period of residence running from July 1998, the period of purchase or the date of purchase, right the way through conveniently a set number of months or a set number of years through to July 2008. And then at that point, he acquired a new dental premises and put the house up for sale. So it looks like we have actual occupation, then a period of really vacancy, and then really sales. So it's not overly complex, this one. And we should remember our, as I've said over the left-hand side here, our deemed periods. It looks like that the two slightly messy ones where the individual is working abroad or employed abroad for any length of time is not being played here. And in addition to that, where, for example, the individual is employed elsewhere in Ireland, e.g. Cork, let's say, that's also not being played here. So we don't have to worry about preceded and followed by a period of actual occupation. It looks as if he just moved out, it was vacant. We only have to think about that last 12 months, which is always in play as long as the individual has lived in the property at some point. Obviously, they won't reoccupy after that final 12-month period. Over and above the information above in terms of costs and dates, etc., it looks like on July 14, he sold the property for $350 and had some legal fees. Again, I'd be looking to simply deduct those and pick up a half mark probably for doing so. Okay, so that's the basic setup on the question itself. Let's have a look at the answer now. Now, this first part, as we've said, relates to the shares. And let me just scan you down the question. You'll see that it's headed up there, asset 1, and then there, asset 2. So where we have purchase of shares or purchases of shares, each of those purchases has to have their own pool. So just watch for that. Now, over and above each purchase having its own pool, just watch the columns here and look what they've done. I mean, they've added that up. Asset 1, I'd probably put in there maybe date or event, because here's where we're sort of populating this particular column with the actual event that takes place. Obviously the first one is going to be a purchase, and then we have bonus and rights. In terms of the other columns, we certainly need a number. That's going to be particularly helpful when we're trying to build in bonus and rights, because they're always based on the number of shares. Obviously, we're going to have a cost column, and then in addition, we're going to have an enhancement, which is effectively the rights area. Okay, we could have a total column as well if you wanted, but I guess that's a little bit of extra work. So in terms of setup, basically, as I've said, let's populate or let's format the question properly. So as they've done asset 1, what happens? There is a purchase in 89.90 of 1,000 shares at that cost. So we're just literally slotting the information in to our columns. The bonus issue, it says it's 1 for 2. So in effect, we're getting 1 share for every 2 that we have. So all that we need to do is divide the number previously by 2 to get our 500. And you'll note that they add up as they go along. That's particularly helpful where we have 2 different types of events here, where that 1,500 is obviously going to be relevant when we look at the rights issue. Now the rights in 2001 was 243, so 2 shares for every 3, and you'll see that all they've done is taken the 1,500 divided by 3 multiplied by 2 to get that 1,000. Quite easy to make a mistake here, so I'd certainly encourage you to add up as you go along. It may seem simple when you look at it, but in the exam you might find that it's quite easy to make a mistake, and you lose a mark or half a mark just for that. So what happens then is that with this rights issue only, because rights are paid for, obviously bonus is free, we're going to populate this enhancement column, and that's just with the value of the rights. In other words, the number of shares and the relevant price. So quite easy to do, just a little bit of multiplication there. So we get down to really our sort of final point, or if you will, our final event. Our final event is always going to be some sort of disposal. Okay, now with these sorts of questions, you'll find that where there are multiple purchases, in this case there's 2, there could be 3, invariably the first asset or the first pool is going to be cleared out completely when a disposal takes place. Okay,
Now, in terms of how we deal with that, well, really what we're looking to do is just extract everything from the pool. In this case, we're extracting 2,500. Obviously, because we're taking everything out, we're taking all of the cost and indeed all of the enhancement cost as well. So these are the figures that we'll be looking to take into our three-liner just below. And you'll see, although I didn't mention the proceeds when we went through the question, you'll see that the three-liner excuse me, is pretty straightforward, and notice that there's a three-liner really for each pool or for each asset. The consideration just given in the question, the number of shares that we're taking out of this pool is 2,500 times the consideration per share gives us the 8,750, and then you'll note that the base cost and the enhancement are just these figures up above here. So we stripped out everything, so we're going to include them. And obviously bear in mind that the indexation for the enhancement will work from that rights date rather than from the base cost date. Base cost indexation is, as you would expect, right back down to 89.90. Okay, so all that we have here then is deductions for the base cost and the enhancement, obviously inflated for inflation, and there's our gain there, 2,419. Now, you'll see that down below here, asset 2, basically the same thing. And note that the bonus and indeed the rights issues, the rights issue affects this asset 2 or this second pool in exactly the same way. And I think that's really something that tends to confuse students, the idea that you have to apply a bonus and a right issue to two separate pools which are effectively the same asset. I guess it seems a little bit odd, but really that's what we've got to do. So again, it works in exactly the same way. For the bonus, the number of shares, bringing nil across. For the rights, again the number of shares 2 for 3, and bringing in the enhancement value based on the per unit rights payment. Now this is the one, because it's the final pool, and we don't have 3 here, you'll see that there's only proportion coming out of these figures, and you really have to do it pro rata. You have to see how many do you need. If you've sold 5,000, you've got 2.5 from asset 1 or pool 1, then you certainly need 2,500 from this, which is effectively half. And you'll see that the numbers here, they're just simply taking out half the value. These are effectively average cost pools, so you take out what you need. And in terms of the three-liner here, works in exactly the same way. You'll note that the indexation is actually the same as per the above 1087, for example, for the rights enhancement cost. Now, they do play a little trick here, and this is something that I would expect, as I've said within classes, to see in the exam, the NGNL trick. In other words, we've got a situation where when we apply the indexation relief, we actually turn what is in fact a monetary gain into an index loss, and we can't do that. So this is one of the restrictions on utilizing indexation relief, and it's tricky in the exam to note that, or to notice it perhaps. So just watch out for that appearing at least once in your F6 exam. This idea that the enhancement has actually created a loss, which it can't do. And you'll see here that they note that there is in fact a monetary gain simply based on the difference between the monetary figures. In other words, the proceeds, the unindexed cost, and the unindexed enhancement. Okay, so in this particular case, if we do get an index loss based on indexation relief and we had a monetary gain, it has to be NGNL, no gain, no loss. Okay, so good marks there for being able to spot that. So that's the two asset pools dealt with. In terms of the PPR, as I've said, this area here, even if we didn't really understand PPR that well, or found it a little bit confusing, quite a lot of marks there for really subtraction for me. We've got consideration, take off the disposal costs, and then we've got the base cost and really all of the fees. They allow for indexation relief here. That's not overly complicated, but we don't do anything in respect to PPR really until we get down here and look at the number of marks that there are just really for subtraction. Yeah, so do try to populate your three-liners in your CTT question. If in doubt, certainly get a proceeds less costs equals gain or loss down as quick as you can, and then just go from there. We're aiming for 50% out of 100, not 100% out of 100. Okay. So there's the first part, really, as I've said, just slotting the figures in and subtracting them one from the other. Now, in terms of this PPR relief, as we said earlier on, I'll just move on to the next page where the explanation is. As we said earlier on, we're really looking to get a fraction, really, aren't we? We're trying to head towards, that fraction, and that fraction being the total ownership years on the bottom, the 16, and then 12. And in fact, this figure is wrong for me. It should actually be 11, but more of that in a moment. So really what we're saying is, what is the element of deemed and actual occupation? Let's get the number of years or months for that. Let's put that over the total ownership period, and let's strip that element out of the normal three-liner gain. Okay. Now, just in terms of the error that I see here, it looks to me as if this total occupation should in fact be 10 years. That figure should be 10 with a final 12 months. That's the deemed period. So I make it 11, but I think we'll just go with the figures in the question for the moment. Okay, so in fact it should be 11 over 16. Now, this area of the trade as well, I mean, the way that it's been done here is, you remember the figure above for 204,414. In other words, that is the gain before any PPR relief. And in effect, what the question is saying is that if the property has been used 20% for private purposes, 20% for trade purposes, then in effect, 80% should be stripped out. I'm not sure if I agree with that, because the property was in effect used for trade or dental purposes up to the point at which he moved into the new property. So really what you would actually have to do, I feel, is to take the 10 years, which is the correct number of years that he occupied it, and take 20% out of that pro rata across the whole period. So that element of the gain would be wholly chargeable. I can't see how you can take 20% of the final 12 months because the property wasn't being used for for trading purposes in that final 12 months. So that element shouldn't, I feel, be adjusted for a trade purpose, because the trade wasn't being carried on at that time. He had a new dental premises. But that's by the by now. So what they're saying is that's the gain. Therefore, only 80% of that gain is going to be eligible for PPR relief. So that's why they only deal with the 163,531 up above. So if we look at their numbers, even though I've said that they are slightly skewed, they take that sort of 80% of the gain. They say, well, that's our starting point. Anything else is going to be taxable, as it were. And they take their 12 over 16 and they're stripping out the element of PPR relief, really leaving 81,766 as being chargeable. Okay, so in terms of a sort of a summary down here, you'll see that we have each of the assets sort of detailed. We have the gain on asset 1, as it were. We have the NGNL, which is effectively 0, and then we have the 81 as above. I've said here that obviously we need to get to this number fast. We can't hang about, and certainly PPR relief questions can tend to take up a lot of time. So just be careful to watch your time. Get the numbers as quickly as you can. It doesn't have to be perfect, as you'll see from the marks breakdown above. If you make a mistake here or there, you're only losing half a mark, because it's method marking. You'll only be marked down once. Never forget the annual exemption. We're getting a half a mark for just laying that out. And obviously, whatever gain you get has to be taxed at 33%. You'll get that half mark even if your figure is incorrect. Okay, so really that's a summary of the CTT question. Apologies, 1 or 2 errors in there. But it wasn't too bad. I could certainly see more complicated questions than this. So hopefully you found that this short screencast helpful. Many thanks for listening.